If I can see the turn in the data already in liquidity conditions in February or March of next year, the market can too, even though most participants can't, which is why the market always confuses people. The market generally bottoms before a recession. It's normally 3 to 6 months. Sometimes it's been a year beforehand. Other times it's been in line with the economy. So my guess is the market has seen the low. So what is the macro driver of crypto? Well, inflation doesn't help because it's taking money from your pocketbook and not allowing you to allocate money into crypto because it's a retail driven market. It also creates a lack of liquidity because the Federal Reserve, to stop the inflation, have been taking liquidity out of the system. So that means institutions and hedge funds have less liquidity to put into the system and therefore less flows into risk assets like crypto. I found the best approximation to be money supply growth, M2, year on year. And year on year M2 looks like it's potentially turning up global M2. We're already seeing that China is going to start picking up M2. We're already seeing that Europe is going to start stimulating through the back door, which is they're going to have to offset the electricity prices, the difference between electricity and gas prices. And they're also giving direct transfer payments to people to pay their electricity bills. So I think that monetary policy changes. It also lags ISM. It's kind of a weird thing. And it tells me that M2 bottoms right about now, which is what the crypto markets, I think, have been telling us. They're trying to find this bottoming process. And if I'm right, the economy slows down, liquidity is going to come up, and crypto is going to rally from here. Let's see. But again, I think crypto is put in a low. I think the ETH merge is a very big deal.
Yeah.
I think it's going to drive inflows. Yes, there'll be volatility. Yes, it won't be a straight line. But I think over time, it's going to put some security into the space because it's done and out of the way. Let's see. Let's hope there's no risk around this. It'll die some of the FUD narratives that are currently building as we move into this, which is only normal and people should question it. And then we'll see on the other side, when you've got this yielding asset that is a giant in the space, what that unlocks in terms of DeFi, the opportunities for institutions to invest, and other opportunities that come from a different asset. Also, the ESG credentials. You know, we all know that Bitcoin ESG credentials are not what the ECB or others will tell you, but that's the narrative that's won the institutions now, that Bitcoin bad, but proof of stake, good. So I think all at the margin, it helps people allocate. So look, I know the Fed want to get to 4%, but my work suggests that the economic data will fall apart too fast for that to happen. I don't think they will potentially get there because the economic data will fall apart faster. So maybe they do a 50 basis points in September, and then they're kind of like, do we do 25? Do we just wait and watch the data? Because they've said they'll go data dependent. And if the data falls apart, 2 months is not a lot of time. So maybe they get 2 rate rises in, maybe they only get 1 in. I think it's going to be difficult if I'm right about the economic data this month. I think it's going to be really hard for them to do 75. I think they'll go 50. They've already said it's 50-50 anyway, whether they'll go 75 or 50. And then we should start to be getting to the grips of the massive slowdown in the economy that I foresee, and therefore they might not get to the 4%. But they will pause and wait. They're not going to cut immediately. That's not going to happen. But they're going to pause and wait. The Eurodollar market and Fed funds market says they start cutting next year, and it keeps moving around when they start that. But that's what they're thinking. The other big part of the equation is the dollar. The dollar is the key asset of all assets. It is 80% of all world's trade is priced in dollars. So if the dollar goes up or down, it matters. The dollar is driven by global liquidity as well. And there's massive dollar borrowings around the world. More people borrow in dollars than any other thing. So when liquidity is drawn away, people scramble to pay back their loans, and then countries go bust, like Sri Lanka did, and places like Colombia have been running into trouble. So the dollar has been on this screaming bull run. It's now the second biggest bull run since 1996. I'm not sure it's yet peaked. It will do when monetary conditions back off significantly, but we're not there yet. Even if rates come down a bit, it's not clear the dollar will do it because Europe is a big drag, China's a big drag. There's some real issues out there in the global economy that means the dollar is still the kind of shiniest currency and the one that people want to own. But the dollar moving up and down drives asset prices a lot because most things are denominated in dollars. So the dollar going up is bad for the rest of the world. So it's good for the US because you import more goods than you export. Therefore, the prices of goods goes down. For other countries, it's kind of inflationary. But what happens is they export stuff. So Asia is the big exporter. If their currency is weaker, it's also going to bring down the rate of inflation over time because they're selling goods. If the dollar goes up 20%, automatically their goods are 20% cheaper. So if you're importing them into the US, they become cheaper, importing into Europe or whichever countries. So it is good for lowering inflation. It's bad for asset prices. It's slightly complicated. And because of the amount of dollar debts, people need to be very careful of the dollar getting too strong, too fast, because it blows shit up.